Welcome to Financial Domination, where knowledge is power. Have you ever wondered why the value of your money decreases every year? It's like an invisible thief is silently stealing from your wallet, and that thief is called inflation. Inflation is a concept that influences our financial lives daily, even if we're not consciously aware of it. Let's demystify this a bit. Inflation, in the simplest terms, is the rate at which the general level of prices for goods and services is rising. As inflation increases, every dollar you hold buys a smaller percentage of a good or service. It's a gradual process, almost like the stealthy approach of a thief in the night, silently diminishing the buying power of your money. Now, you might have heard about the goal of a 2% inflation rate. This means that every year the purchasing power of your money decreases by 2%. In essence, you can buy 2% less each year. But why is this happening, you may ask? Well, it's by design. Central banks around the world aim for a certain level of inflation. They believe it's a sign of a healthy economy. But like a double-edged sword, it also means that the cash in your pocket loses value each year. The effects of inflation are felt most acutely by the middle and lower classes. It's like an invisible tax, one that doesn't require legislation but still takes a bite out of your income. The wealthier segments of society, with their vast assets and investments, can often ride the waves of inflation, but for those living paycheck to paycheck, it's a different story. However, it's not all doom and gloom. There are ways to combat this invisible thief. By making your money work for you through investments in assets like cryptocurrencies, commodities such as gold or silver, you can get a return on investment that exceeds the rate of inflation. So you see, inflation is a reality we all face, but what causes it? That's a story for another scene. Like and subscribe for future content. Ever heard of the term money printing? It's more connected to your shrinking wallet than you might think. Imagine a scenario where the government decides to print more money. Sounds great, right? More money means more to spend. But here's the rub. When more money is printed without a corresponding increase in goods and services, you end up with more dollars chasing the same amount of stuff. This is where the concept of inflation steps in. Remember when a candy bar cost $0.25? Now it's $1 or more. That's inflation in action. The basic laws of supply and demand dictate that when there's more money and the same amount of goods, prices go up to balance things out. So if the government prints more money, it's not making us wealthier. Instead, it's decreasing the value of the money we already have. This is the sneaky way that inflation works. It's like an invisible hand dipping into your wallet and taking a bit more each year. This money printing phenomenon is a significant contributor to inflation. It's not the only factor, but it's a big one. It's a cycle that's designed to keep the economy moving, but it also means your dollars are worth less every year. In essence, when more money chases the same amount of goods, prices rise, and that's inflation for you. Inflation, in many ways, acts as an invisible tax. And guess who it hits the hardest? Let's unpack this a bit. The middle and lower classes often feel the sting of inflation more acutely. But why is this? Well, the cost of living, think housing, groceries, education, tends to rise faster than income. So if you're earning the same amount year after year, but everything else is getting more expensive, you're essentially losing purchasing power. That's inflation at work, and it's like a stealthy pickpocket, gradually emptying your wallet without you even noticing. Think about it. Inflation at a rate of 2% means that every year, your money buys 2% less. It's like a silent tax that's constantly nibbling away at your earnings, and it's engineered into our monetary system by design. Now, add to this the phenomenon of money printing. When more money is pumped into the economy, it dilutes the value of the dollars already in circulation. This can lead to even higher inflation rates, further eroding your purchasing power. But who feels this the most? Again, it's those in the middle and lower economic brackets. They're the ones who see their hard-earned money losing value, while their salaries remain stagnant. But don't despair. There are ways to combat this invisible tax. No one likes to see their hard-earned money lose value. So, what can you do about it? Well, the answer lies in investing. Instead of letting your money sit idle, you can put it to work, generating more wealth over time. This can help you preserve your wealth and potentially even achieve financial independence. First, let's talk about cryptocurrencies. They've been making waves in the financial world, with Bitcoin leading the pack. These digital assets are decentralized, which means they're not controlled by any government or institution. This makes them somewhat immune to the inflationary policies of governments. Plus, the potential for high returns makes them an attractive option for investors. However, they do come with their share of risks, and it's crucial to do your research before diving in. Next, let's consider commodities like gold and silver. These precious metals have been used as a store of value for thousands of years. They're tangible assets that can't be printed or inflated away at will. When economies are unstable, investors often flock to gold and silver, making them a potential hedge against inflation. However, remember that all investments come with risks. Prices can fluctuate, and there are no guarantees. Therefore, it's always wise to diversify your investments. Put your eggs in different baskets, so to speak. This can help spread your risk and increase your chances of seeing a return on your investment. One way to ensure a return that exceeds the rate of inflation is by investing in income-generating assets. These could be dividend-paying stocks, rental properties, or even a side business. The idea is to create multiple streams of income that can help you weather any financial storm. It's also worth mentioning that financial education is key. Understanding the basics of personal finance, investing, and tax planning can go a long way in preserving your wealth and achieving financial independence. Remember, the key to financial independence is making your money work for you. So start your journey today. The road may be long, but the rewards can be well worth the effort. So, what have we learned today? We've demystified inflation, that invisible thief, and understood how money printing fuels it. We've recognized it as an unseen tax, felt hardest by the middle and lower classes. But we've also discovered potent ways to defend and grow our wealth. By making smart investments in assets like cryptocurrencies, commodities, or other avenues that offer returns exceeding inflation, we can make our money work for us. With the right knowledge and actions, you can turn the tide on inflation and ensure your money retains its value. Now, you're not just working for money, but your money is working for you.